US markets?
Absolutely. You know, what a mayhem it's been globally. If you take a look at the US markets over the course of last week, initially started the week pretty strong, but then you had jobs data coming in that was rather weak. And, you know, it's a one-way downhill after that for the US markets, because if you take a look at these indices on a spot basis, even on Friday, you have Dow Jones that's lower 1%, S&P 500 is closed by lower by 1.7%, you have NASDAQ that's closed lower yet another 2.5%. So these are big losses coming in for Wall Street over the last few trading sessions over the course of last week, and futures are also not looking very bright as of now, and the stock market suffered serious losses in its first trading week of September, due to which is usually a seasonally slow month for equities, but this time we also had other add-ons to it, another catalyst that brought the market down, especially the job data in the US that was weaker than expected. Now the S&P 500 has stumbled 4.3% over the course of last week itself, registering its worst week since March 2023. NASDAQ has also plunged 5.8% just on the last week basis, and that's its worst weekly performance since 2022. Dow has also dropped almost 3% on a weekly basis last week. So, you know, big cuts are coming in. We usually are very used to seeing these cuts, if at all we see on a monthly basis, but seeing such big cuts on a weekly basis sure is a cause for some caution in the US markets. Now, largely, like I mentioned, primarily the weak job data and the labor market situation in the US was one of the big factors that has taken a big toll on Wall Street. Now, economic data released Friday also revealed that non-farm payrolls grew just by 142,000, missing that 161,000 gain that was expected by economists. On the other hand, the unemployment rate ticked lower to 4.2%, so at least that was a slight bit of a positive data point coming in for the US markets, but that was also largely in line with what the economists were expecting, what the street had penciled in. So no major surprises on that front. At least it wasn't worse than what was expected. It was largely in line. Let's see if that metric, the unemployment level of 4.2%, let's see if that is able to help the US markets buck up in today's trading session. Now, if you take a look at data this week, investors will be watching out for two key inflation reports that could further inform the Fed Reserve on the course of action that it needs to take in its September 17-18 meeting. Remember, now you have a larger chunk of people that believe that the Fed will undertake a 50 bips rate cut in this meeting that's all set to come next week, and August consumer and producer prices reports are slated for release on Wednesday and Thursday morning respectively. So now, like I mentioned, you have a 71% chance of market participants penciling that the Fed will be taking a 25 bips rate cut, and you have a 29% chance estimating that it will be a 50 bips rate cut. So largely that is what is going on with the US markets right now. It's not looking good, and we also have some fresh data coming in from China. We'll take you through it just as we get more data on that. But on that note, let's also take a look at what the European markets were up to, and it's not looking good on that front as well, because like it said, if the US sneezes, the whole world catches a cold. You have DAX that's closed 1.5% lower, FTSE down 1%, Stock 600 also slightly more than 1% in the red. That one has also been falling freely over the last couple of trading sessions. So, well, yes, that is what the global equities are looking like as of now. But Shreyansi, I think oil is holding up pretty well.
Well, absolutely, and we'll take a look at that. But like you said, if the US sneezes, the whole world catches a cold. So let's see how it pans out for us in trade. But when we take a look at US crude oil, you're looking at US crude oil hitting the lowest level since June 2023 coming in, putting the benchmark on pace for its worst week in nearly a year coming in there, as OPEC Plus has failed to reassure the market about the global supply and demand balance. So that is something that we're looking at when it comes to oil. Now, US crude oil hit a low of $67 earlier in the session as well, and shed 8% for its worst week since October. So those are the kind of moves that we saw coming in for US crude oil. And to Brent global benchmark as well, you're looking at losses of about 9.8% this week as well there as well. Now, when you take a look at WTI, you're looking at $67 per barrel levels, downtick of about 2.1% coming in there, and year to date that contract has fallen 5.6%. When you take a look at Brent as well, $71 per barrel is where that one was at, 2.2% downtick coming in for that one, and year to date the global benchmark has also declined 7.8%. So those are the kind of moves that you've seen coming in for this as well. Now, keeping it with the oil market, then Goldman Sachs has maintained its Brent crude range of $70 to $85 per barrel And in December 2025, now when the Brent forecast that they're talking about is just about $74, and that's something that they've highlighted. The investment bank also expects the effects of a modest reduction in OPEC plus supply in the upcoming months to be counterbalanced by easing effects from the current softness in China's demand and faster than expected recovery as well of Libya's supply.
If you like this video, then like, share and subscribe to ET Now.